Welcome back. It's time now for the Word on Wall Street. Top investors watching your money. Joining me now is Verdence CEO Leo Kelly. Also with us is Luke Lloyd in the studio. Leo, great to see you. Thank you for joining the conversation.
It's great to be here, Maria.
Big rally underway. Futures indicating a gain of 300 points on this first open for the final trading week of November. Dow Industrials up 279, the NASDAQ up 105. To what do you attribute this big move?
Well, we just have seasonality. There's plenty of optimism in this rally that earnings are going to be better next year as regulation goes down and potentially the tax cuts stay in place. I think there's some legitimate optimism here. We just have to look at valuations and be mindful of allocations.
Yeah, a lot of optimism of the Trump policies coming in. What's your take on interest rates? Take a look at the 10-year Treasury yield this morning, Leo. Futures market is pricing in a 53% chance that the Fed cuts rates by 25 basis points at the December meeting. But a recent Fed survey finds that the U.S. government's debt load is now seen as the biggest risk to financial stability, outweighing persistent inflation. This is something actually that we've talked about in the past with Jim Grant from Grant's Interest Rate Observer. But we've got a big week of economic data on deck. We get the second read of third quarter GDP out this week. We'll get the October PCE index out on Wednesday. So inflation data, the favored inflation metric from the Fed. Your reaction and expectation?
Well, Maria, you and I have been talking about this for the last couple of years, that coming out of COVID, M2 exploded like third world country growth. And with all that capital infused in the system and the excess spending that's come from the U.S. government, there's just too much money in the system. So this optimism that inflation is down and that's going to stay down, I think is a little over-optimistic. I think there's still threat inflation goes up. That you're seeing it in the bond market. The bond market is telling us that inflation is accelerating. We're starting to get hot reads again. And as soon as the Fed just backs off a little bit, inflation starts to come back and interest rates start to go back up. This is going to be a constant push and pull between the Fed and the markets. And I think when we look at equities are going to respond to these expectations for interest rates. There's just too much money in the system. That's inflationary. And the Fed, this is a fight that's going to be ongoing. Inflation doesn't just go up once and come down and stay down. Inflation at the level we saw it over the last couple of years, it takes a few runs up and down before you get it under control. We're in the early innings, not the end.
Yeah, I mean, that's what Jason Trennert has told us many times, that oftentimes when you have a spike as significant as we had, in other words, up 6% or more, of course, we went all the way up to up 9.1% on the CPI at its peak, that when you have some kind of a spike as significant as that, you often get a second spike. And his research has shown us that. We've been waiting to see if, in fact, it flares up again. But what we've seen is a big market led by big tech, a big market rally, Luke. Let's take a look at big tech this morning. The Journal this morning writes this: tech titans have a new way to measure who is winning in the race for AI supremacy, who can put the most NVIDIA chips in one place. Luke, you say AI needs to work, but there's a whole world of investments outside of the Mag 7. So how else do we get a piece of that?
So I think I'll go as far as say I think 2025 could be the year for the 493 or the equal weight S&P 500. I think the equal weight index could actually do better next year than the cap weighted S&P 500 because there are so many other investments out there that are going to benefit from the macro things that this presidency and this administration is going to implement. I think one of the reasons why not only the market futures are up this morning, but also why bond yields are down this morning is because of Scott Benson coming in there, making sure that we do implement these policies that are going to be actually more deflationary. Because one of the things you hit on earlier was the government debt out there, $36 trillion in debt. We can't continue down this path. So when you pull back government spending, when you actually allow the free markets to work properly, which is usually actually deflationary in the end, you actually get a much more deflationary environment. And you have Trump out there saying that he wants interest rates lower, which means bond yields need to go lower. So I think the bond market actually has been wrong the past couple of months. So if that's the case, you want to start looking at more more dividend stocks or stocks that are going to benefit from this deregulation, lower tax environment. Stocks like AIT, Applied Industrial Technology, that helps manufacturing firms with technology. You have Union Pacific railroads that are going to help with transportation of goods as you have onshoring and stuff like that. A lot of these stocks pay dividends, and if you have rates going lower, not only do you have a boost in earnings from the policies being implemented, but you have a boost because rates going lower is good for dividend stocks.
Well, what about supervision of big tech? I mean, there's a lot of expectation that we're going to see a heavier hand in terms of supervision of these big tech companies. I've got a report from Cowen & Company in front of me from last week. They say, we believe direct CFPB supervision over large tech platforms like Google is inevitable as the lines between banking and commerce increasingly become blurred. Are you worried about that, Luke, with big tech?
It's definitely a risk because as we've seen the past 4 years, and what we are probably going to continue to see until something big changes, is the big get bigger, the rich get richer, and the small get smaller. So these big tech names, some of them are on the borderline of being a monopoly because they are so involved in so many different things, and they have so much cash on the sidelines. So that is definitely a risk for some of those stocks, but also a risk is all the spending that, we talked about how I think AI needs to happen because you have a declining population, like a population kind of where, younger people aren't getting married, they're not having kids. So if you have less heads in the society, you need technology to replace that productivity. So AI needs to work out, which is why AI spending is not going to decrease or decline anytime soon. So you have all this spending around AI, that's going to hurt some of these earnings until they turn profitable around this. Again, I think the years of being a big tech, only making money are kind of over for now.
Well, I want to get your take, Leo, on how much of this optimism is already priced into this market. A lot of investors were betting on a Trump return to the White House, and they've been bidding up stocks going into the election. We showed the November markets. You've got 5% moves across the board there. We showed the year-to-date markets, double-digit moves. And, of course, now we've got all this optimism around Bitcoin. We spoke with David Towell earlier in the program from ProChain, and here's what he said about Bitcoin in the next year. Watch this. What's your prediction for the year end and into 2025? How high can this go?
So I think we definitely cross 100,000 shortly, maybe even today. It would be quite auspicious day to cross 100. I think by the end of next year we get to $250,000, and it's not just putting numbers out there. There's really a lot of substance behind this. As you've noted, the market has been on a good rally since Trump's election. I think we'll continue to have the Santa Claus rally into the end of the year. And then when President Trump takes over and
Leo Kelly, your reaction, you agree?
Well, a couple things here, Maria. One, I understand the optimism on interest rates falling and the economy continuing to do well. It's going to be hard to get both of those together. The market is extraordinarily optimistic right now. Valuations are elevated. We're in that Santa Claus rally, as he said. This is a seasonal run. The first quarter, especially in the first year of a new presidency, the first year doesn't tend to be as high as the past. I think we have to be mindful and disciplined in this market. This market has run a lot. There's been a lot of optimism. Hard to imagine that we're going to get, with all the capital in the system and all the spending, that we're going to get interest rates going down and an economy going up. That's just not how it works in a high inflationary market like this. And when people say inflation's coming down, it's not coming down. Prices are going up just at a slower pace.
Yep.
As far as Bitcoin's concerned, it's a supply and demand issue, not a valuation issue.
And not a lot of supply.
That's correct.
Is that your point? Not a lot of supply?
Not well, but Maria, my point is, how do you value something that doesn't have cash flow? This is just, will people continue to buy and pay more? The case for Bitcoin is simple. Somebody pays more than the last one.
This good question for you. Leo, great to see you. Thanks very much for joining the conversation. Leo Kelly. Luke, you're with us all morning, and we appreciate it.